I think we got to start on the U.S. Fed. Again, no decision expected tomorrow, but a lot of thoughts about what Jay Powell is going to say, or at least hint at. What are your expectations when it comes to the U.S. Fed? What is the impact on the European bond complex and also broader global equities?
Well, it's the multi-trillion-dollar question, isn't it? I think there won't be any nasty surprises this week. All along, the Fed, and indeed I'd have to say all the major central banks, have been very keen to give as much forward guidance as they're permitted to. So I think what will be really interesting this week is not so much actually the rate decision, which we very much expect to be held, but the press conference afterwards, as you alluded to, because I think he's going to take the opportunity there to reinforce some of that higher for longer rhetoric and indeed give some sort of scope or some indication of when we expect to see rate cuts. Now, we are still very much in the camp that we will see rate cuts this year, but it's way off what markets were expecting at the beginning of the year. You know, just a few short months ago, this was going to be 6 rate cuts in the US year, but it's absolutely now not looking that way. We are thinking a couple of rate cuts this year, and then perhaps a pause for a little bit.
Well, a couple's a little nebulous. So 1, 2, are we talking 25 basis points each time?
This is also the really interesting question, right? It's what the depth of those cuts. I think potentially we end the year 25 to 50 basis points lower than we are today. Now, you know, we've got to leave ourselves a bit of room for maneuver. Ultimately, what we're saying, though, is fixed income looks like a really attractive asset class right now because, yes, we are higher rates, it's going to be higher for longer, but the trajectory from here is down, and we'd rather be a little bit early than a little bit late on these things.
So you just mentioned fixed income, which I wanted to ask you about. I had a guest on earlier today on Street Sounds or European shows, believing his forecast was that the boon, it would hit its high end of its range at about 2.5. It's obviously a few basis points above that. The Fed staying higher for longer and the ECB expecting a cut in June. How does that impact fixed income? Where do you see the biggest opportunities? I would think it would be on the short end of the curve in the U.S., but he actually believed it was on the long end of the curve in Europe.
Well, I think actually the best opportunities here are a mixed bag, right? You've got some really enticing yields. You know, just a couple of years ago, in order to get 5%, you had to be in pretty kind of sex, drugs and rock and roll territory for fixed income. We're talking high yield, we're talking, you know, local emerging market debt. Now you can basically get that in the US. It's quite a thing. So locking in some income now and having a strategic point, you know, strategic option of looking around the globe, but very much in developed markets. Now, to your point, I do also agree that the ECB will move before the Fed in cutting rates, and indeed I think the Bank of England will do the same. Now, interestingly, not just what does that do for the fixed income market, but also what does that potentially do for inflation in the UK, because, of course, if rates are higher in the US, that means rates are more attractive in the US, and then you could potentially get this secondary imported inflation act because of the impact on the currencies. But central bankers will be highly aware of those risks.
So we mentioned we're in the middle of earnings season, not only in the U.S., but here in Europe. A lot of big companies reporting today. Automakers actually under some pressure after their reports. What are your expectations for earnings season in the U.S. and over here in Europe? And will that keep the rally going this year? I know you're UK-based. We're seeing the FTSE hit new highs pretty much every day, and the U.S. indices about 3 to 4% away from their all-time highs as well.
Well, you'll know this, it's context, right? I mean, FTSE's hit its all-time high, but it took long enough. It's taken a very, very long time. You know, in the last year, we've seen, you know, it's a difficult month for the S&P 500, but in the last 12 months, we've had several all-time highs. We've even got Japan at an all-time high after, you know, nearly 4 decades. So I think the FTSE we are stronger on. We do think earnings, although more patchy than in the US, we have seen some really great results from financials so far in the last week. We expect it to be positive. We are very much mindful of the fact that inflation remains a factor.
Okay. You're dodging a bit, Emma. Do you expect earnings to basically show and confirm what investors have been looking at, that AI story, which is really that market concentration, the mega cap tech stocks, and keep the rally going with some broadening, or will earnings actually push investors one way or the other? I'm putting you on the spot.
I do think that the Mag 7 story continues to run. It is a narrow trade. S&P 500, we think, will have continued volatility this year. We do think it's an opportunity to take some gains and recycle that back into where we see value, which is in the UK, despite hitting all-time highs in the last week.